Yes, I mean, it's very easy to assume that when UK growth is doing well, smaller companies are going to do well. But actually, the real driver of small companies is the ability to grow when the world's not growing. And actually, if you look at what happened in the 70s and the 80s, when the world was really challenged, the UK had a huge number of recessions. We had inflation shooting up, the oil price crisis, currency crises, etc. Small companies outperformed. That's what drives small companies. When you can't get enough return in the big ones and the indices, you've got to get into small caps. And that's why nearly all universal funds had not just big companies, but about 10 or 15% in the very smallest companies. Well, clearly the important thing is to make proper money for our clients. And I think one of the areas we can add more value is by getting around to a very large number of companies. So we don't cut off at 100 million or 50 million or any particular number. We look at whatever size the company, because if we can only get perhaps £100,000 into a £10 million company, if it goes up 3 or 4 times, it makes £500,000 for our clients. So we're very much more open-minded, I think, in that regard. We're also reasonably early adopters. We like to make sure we've got lots of tangible assets in our funds. Not all of the stocks have good tangible assets, but often when they recover, these recovery stocks recover very substantially. So we often go for recovery stocks rather than the higher growth stocks, which is more typical in the sector. Yes, it's interesting. I mean, there are a lot of risks in all small companies, but many of us who have invested in AIM have found that some of those stocks have done very badly. The .com, it was very exciting at the time, but very, very few people made money. Some of those companies involved in commodities and mining, very exciting when the commodity prices were going up, but often they didn't necessarily find the excitement they got, and the returns are very poor. So we've got quite associated with those kind of risky companies. What we're really interested in investing beyond the credit boom are companies which are regular businesses, regular turnover, small ticket items, which they can sell more each year, grow their cash flow, generate dividends, grow those dividends and drag their share prices up, even if the market isn't helping us. Yes, I mean, AIM has a lot of companies in it which are well positioned to recover. The FTSE SE small cap market is kind of a good market, but it's not as well, it's not as isolated, it's more picked over than the main AIM market. And because of that, there's more valuation attractions at the AIM market. There's more opportunity at the bottom end of the AIM market. They're more numerous. They're less part of an indices. And for that reason, you can find stocks which make much better returns on the AIM market. The FTSE small cap market would still do well, but AIM, I think, will do better.